How can you nail your property investment tax deductions? I'm Mike Loader. Investment Insight starts right now. Hello everyone and welcome back to Investment Insights, presented by the team at The Investor's Way, where each episode we provide informative interviews about wealth creation alongside those practical tips of how you can master your money. On today's program we talk all things property tax, and joining me now as always is my co-host Andrew Woodward from The Investor's Way. Good to see you, my friend. Thanks for joining me.
Thanks for having me back again, Mike. And today we're talking tax deductions, and we've brought the right guy because he can make it interesting. And I'd like to introduce you to Mike Mortlock from MCG Quantity Surveyors.
Wonderful to have you with us. Thanks for joining us.
Thanks for having me. You've set the bar high though, making tax fun and interesting.
Yeah, exactly. So to kick us off, what's your favourite statistic when it comes to tax deductions?
Yeah, well, we analysed 1,000 residential property investors that came through our system, and what we found is that 6.7% of them waited too long to be able to claim their deductions, i.e. there's a period of time where they bought the property and they contacted us, and you can normally back claim a couple of financial years, so we're talking people that waited longer than that. Now, on average, they missed out on $20,537. Now, that doesn't sound like a heap when you're talking about 6.7% of the population, but if you extrapolate that across all investors as we did, the grand figure was $2.88 billion worth of unclaimed deductions floating in the ether.
Unbelievable, isn't it? And it's like that mic drop moment. Yeah, $2.88 billion.
Where is it buried under a tree somewhere? Can I find it?
Well, I'd like to think you could geocache it somehow. We could go on a little hunt. But it's in the potential pockets of investors, and I think that if you want to pay more tax, that's up to you. But these are your entitlements, so you should claim them. And if you don't want it, give it to charity, not the federal government.
Yes.
Right?
Yeah. And so depreciation is one of the big tax deductions that we all know about. So what are the three triggers that suggest an investor needs a depreciation schedule, which I know is one of your favourite toys?
Yeah, because I suppose there are a lot of people that want to give some advice on tax depreciation, and it is kind of quite a boring topic for a lot of people. So I thought, how could I simply explain, if it matches one of these three triggers, then there's value in a report. So the first one is that you buy a brand new investment property, and we all kind of know that just means you get all the plant and equipment, you get all the structure. The second one is it's built after the 16th of September 1987. Now that's the cut-off date for depreciation claims on the original building structure. Yeah. Born?
No.
It's a Taylor Swift album or something like that.
Good call.
There you go. So if you say buy a property that was built in 1990 and it has $100,000 worth of structural improvements, or say building, that at 2.5%, that's $2,500 a year worth of deductions. So the report's definitely paying for itself. And the third one, it doesn't match one or two. It's not a brand new property. It wasn't built after 1987, but what we're looking for then is the history of the property. So if it's had renovations, and it doesn't have to be renovations that you've done as the property investor, it can be by the previous owner. So what we do is we look at, let's say there's a kitchen and bathroom renovation, we're qualified to estimate the value of those works. So if it's had around about $50,000 worth of deductions, that's about the break-even point for a depreciation schedule. Now, 50 grand used to get you a kitchen and bathroom reno, now it's probably a plumber's call-out fee, right? So, and if you think about it, properties built pre-87, most of them will be renovated because you're going to get the best quality tenant, you're going to get the best quality rental return, and if you're wanting to redraw equity, you get the property valued, you want it to be nice and fresh. So that really means that most properties will have enough depreciation deductions available to justify the cost of a report.
Yeah, look, I highly encourage people go and get those depreciation schedules, and you've actually answered my next question, was how does that impact my renovations? But you've told us, obviously, there's an element there where we can claim tax deductions for our renovations. So that's a great thing.
I'm curious to jump in though, and if something you hear all the time is, if you claim these deductions, aren't I just going to have to give it all back when capital gains tax rolls around again?
It's a good question. It's normally a question that actually gets heckled at me when I'm on stage presenting, right? Because it's like, oh, that sounds all very well, Mr. Cheap Haircut and Glasses, but don't I have to just give it all back? I think there's a bit of misunderstanding about tax depreciation. So really, what it means is if you buy a place for, say, $1 million and then you sell it in 2 years' time for $2 million, well, firstly, you're a great investor because that's a good return. But if you claim, say, $10,000 worth of structural deductions over that period, it kind of looks as though you bought it for $990,000 rather than $1 million. So you're paying tax on that greater amount. It actually reduces your cost base when you buy the property. But you don't actually give the whole amount back, because if you own the property for more than 12 months, you get the 50% CGT exemption, and then it's at your marginal rate of tax. And you've got to factor in the cost of $1 today rather than tomorrow as well.
Yeah,
I've got to jump in and wrap up the program. I could listen to it all day to find some tips and tricks, but thank you so much for joining us, Mike.
Thanks for having me.
All right, that's the program for now. Head to theinvestorsway.com.au for more information. And of course, the information provided in this program is for general informational purposes only and does not constitute professional financial advice. Go and do your own research. As always, we suggest you do that. I've been Mike Loader. Thank you for watching. All the best.
You're watching Ticker. We'll have more in just a few minutes.